Yo, how's it going everyone? Welcome back to another video. We're finally in the last phases, the last stages of the course. Let's get straight into this. This one is going to be on Wyckoff. I know Wyckoff is so confusing, and I'm going to be honest with you guys. When I first figured out Wyckoff, when I first heard of it, I was so lost. I was like, damn, I can't believe people really use this. It's so confusing, but I'm going to try to simplify this in such a easy way to understand and implement. So first off, let's actually read all this information over here, because most people, they're not reading this, right? You're not reading what the PS means, what the selling climax is, what the automatic rally is, because that's how we all learn, off of reading. So the preliminary support, in this case in the accumulation schematic, this is where substantial buying begins to provide pronounced support after a prolonged down move. Volume increases and price spread widens, signifying that the down move may be approaching its end. So basically what this means is this is basically that last move, right before that last move down, a lot of buying contracts come into the market, and that's basically your first sign that the sell side move down that you're seeing right here, this mark down, lower low, lower high, it might be coming towards an end. And I'll show you guys how to identify the PS. It's really simple. So it's basically just your first identification that the market may be reversing and changing trend. Now the selling climax is not the opposite, but it's basically the same thing as the PS, but just a more distinguished version. So SC, selling climax, this is basically the real move up, the start of your schematic. So this is where a lot of buying pressure is going to start, happening. A lot of buyers, there's a lot of sellers who were selling are going to close their trades, and buyers are going to start coming into the market. So imagine this as your first support with a bunch of momentum. Let's read this. The point at which widened spread and selling pressure usually climaxes, meaning finishes, and heavier panicky selling by the public is being absorbed by larger professional interest at or near a bottom. Often price will close well off the low in SC, reflecting the buying by these large interests. So if that's confusing, just imagine this as where sellers are out of the market and buyers come in. So right after the selling climax, what you're going to see is an automatic rally. And now the automatic rally is basically just an immense amount of buying pressure happens, and they basically make a rally towards the PS, right beside the PS, which occurs because intense selling pressure has greatly diminished, meaning it's gone. A wave of buying easily pushes price up, so a bunch of people are buying now, right over here where my cursor is, and this boosts price up, which creates a lot of momentum towards the upside for price to go higher. This is further fueled by short covering. The high of this rally will help define the upper boundary of an accumulation trend. So yeah, that's basically what an AR is. Now a secondary test is basically the market coming back down to pick up any orders at the selling climax. So you know how we have order blocks and institutional candles and demand zones? Basically, let me open this up, paint, and let me explain this in a really simple way. Basically, you have your mark down and then you have this push up. Now inside of this push up, you're gonna basically see a demand zone, right? You're gonna see an institutional candle most likely, and the market is gonna have to come back down to retest that institutional candle, and this can be seen as your secondary test, where the market makes a second test in the same area of that selling climax, and then from there you'll most likely see a small wave of buying pressure form. So then you see that move up towards, and now we're in phase B. Now phase B is basically the market just manipulating the selling climax and secondary test. So you see that after we have that secondary test, the market makes a move up. What we basically have now is our selling climax right here, and then we have our ST right over here. What this now, phase B starts, this is phase B right here. What we're basically expecting in phase B is for the market to make a run below the secondary test and the selling climax. The reason we're expecting that is because there's obviously liquidity now. Now this is a different type of liquidity. It's not the traditional equal lows, equal highs. But basically the market is gonna have to break below. It's gonna have to break below the secondary test and the selling climax to stop out any early buyers. Because even though we do understand what the selling climax is and automatic rally and secondary test is, we're not really looking to get in positions until we're in the final stages. So anyone that's entering phase A is basically about to get stopped out. They're basically going to get stopped out. So the market pushes down, sorry, so the market pushes down to hit the stops on the selling climax and secondary test. And then we have that secondary test in phase B. Now this is where things can get confusing. So we have the STB, but that doesn't mean that there's only going to be one. Sometimes you're going to see multiple secondary tests in phase B before you see a spring. So I'll get into that later. So we have that secondary test in phase B, clearing out all that money below. And then whatever, blah, 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 market just consolidates a bit. And then we have the final spring. So the spring is basically another secondary test after phase B, but in phase C, it's just called the spring. So basically this is that last point in the market. Oh, excuse me. But it's that last point in the market where the market is getting ready to actually make its bullish rally up. So it's you know how the STB cleared the ST and the SC? The spring is basically clearing the SC, ST, and the ST and B. It's that final manipulation of the low down before the major move up. And now I'll completely help you guys understand how to actually trade all this. Don't worry. Let's go to AUD/USD. So brand new chart, right? Obviously there's a nice schematic here, and I'm going to show you guys how it happens. So by the way, if I didn't say this already, accumulations happens at the bottom of a downtrend and distribution happens at the top of an uptrend. So we're in an accumulation schematic right here, and let me explain why. So first thing first, how do I find my PS? Well, let's go to the line chart and let's try to find out what was that last prolonged move down before we had a quick shoot up of buying pressure. In this case, if we're looking at this, let's try to copy exactly what's here and put it on our charts. Right over here, we can see that the market created this markdown, and right over here, before the market made this last move down, we got a major push up. Let's look at the chart. We have this last move down right here, right? And after the last move down, we finished right here, and the market pushed up. So just because of that little bit of information right here, I can assume that this is my PS. Yeah, that's my PS. Now, because I know this is my PS, by then I'll already know this is my selling climax. Because why? Because this is that basically right after the market did finish its down move, we had a shoot up and a wave of buying pressure. And that's what happened right here. The market pushed down and shot up and gave us that wave of buying pressure coming in right here. And the way we can identify that is just by looking towards the left. We can see that this move up hasn't happened. The market is moving in waves of this. Randomly it shoots up. Clearly there's something interesting about this area, and that's what the selling climax is. Now after that selling climax, we have an automatic rally. The automatic rally is basically just making a push back into the PS. Now in this area, the automatic rally pushes up towards the PS. It doesn't necessarily need to be below the PS. Even if it's a little bit above, it's completely fine. But if it's below, it's obviously better. So in this case, the market makes an automatic rally where a lot of buying pressure comes in, and this is basically the start of the schematic. So I'm gonna make like a little line right over here, vertical line. Let me see if I can change this style. That's nice. Boom. So we have our phase one finished, right? So we have the PS, we have the selling climax, and now the automatic rally. Now for the people asking me, how did I find out this is my automatic rally? The automatic rally is literally anything, any move up that's followed by a move down. So someone might say, okay, wait, how do you know that this is the automatic rally if price is just over here? I'm going to be honest with you. At this point, it's impossible to know. You might know that this is your PSSCAR, but in all honesty, I don't know the schematics until price is like all the way over here. So you have to let the schematics have patience. You can't like see Waicof happen anywhere, anytime you want. It happens at certain times in certain places in the market. So make sure you're patient. So after the automatic rally, the market does this. So we basically saw our PS, which was this move right here. The market basically used that PS as a supply zone to go down. So right here, we can see that the market created this nice supply zone, and then it pushes back down. Now, what's next is we're supposed to be looking for ST. So we have our secondary test right over here where the market comes back to the original selling climax point, which is right here. And like I said, you're going to see a demand zone there. And in this case, we do see a demand zone right here. Price dips down into our selling climax. And this is considered as our secondary test, without the market is retesting any little bit of demand. Now we're in our phase B of the market of Waicof. Now phase B is basically, like I said before, we're basically looking for manipulations of the SC and ST. Because if you really look at it on like the candles, sorry, that's really ugly, my bad. If we go down to like the 15 minute, if it allows me to, what you'll see is intraday liquidity right here. If you scroll down to the 1 minute time frame, you'll see a ton of support, right? And on the secondary test, you won't see liquidity, but if you really look at it, you can see that there's a double bottom right here, and obviously it got taken out, hence this was the ST and B. So basically there's a bunch of liquidity all over the market, and that's what Wyckoff really is. It is just the market taking liquidity and in a specific way, right? It's not just gonna what do you call it, like take liquidity in the way that we see on the 15-minute, 1 minute, but it's basically just taking liquidity out. So right over here, after our secondary test, we still have the selling climax to manipulate. So let's see what the market does. We need to see a ST and B, so let's see if we have that. Right over here, do we break below it? Yes, we do. The market gives us a break of structure of the lows, and this can be considered as our ST and B. ST and phase B, that's basically what it means. The market now, what it did is it just took out the money of the secondary test buyers and the selling climax buyers. So at this point, you still may be confused saying, okay, wait, how do I actually trade it? Trust me, I'm going to get to the how we trade it, how we enter. Just keep watching. So now we're in phase C or phase B, where we see the market take the low and then it rallies up. Now right here, we take the low and we do have a rally up, but it wasn't a big rally the way we expected it. After we do take the ST and B out, someone might think that, okay, wait, you have one more push down and then the market pushes up, right? And in this case, someone might say, okay, isn't this the spring? Now, I'm going to help you guys how to differentiate from multiple ST and Bs and from the actual spring. So the way you identify which one is the real ST and B and which one is the spring is just by identifying the volume in the market, right? So over here in this area, you can see there wasn't a lot of volume. It's just a ton of ugly wicks. The market didn't have much momentum. It didn't shoot up really quickly. It took its time. There's more wick than candle, no momentum at all. So clearly this was not the spring. This was generally just another ST and B. Like I said before, there's going to be tons of STs and Bs. And it's literally impossible to assume, okay, the spring is going to happen below here. The way you'll understand when the spring is going to happen is simply by waiting and having patience, and I'll show you. So at this point, the market makes its rally up, and we can see that in phase B, we see a major rally up. And it generally does not break the PS. So, sorry, not the PS. It generally does not break the PS, but it can break the PS. It doesn't necessarily have to respect it. So now we're in phase C, right? We're in phase C. And this is the most interesting and most, what do you call it? Like the most important part of the Wyckoff schematic. So as we saw that the market created this a second ST and B and pushed up, what we kind of did is created more liquidity. Right here, the market created a trend line liquidity for the market to take out later on. So we have multiple tests here, 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 and here. Now, you may have seen this called as a creek. A lot of people know this as a creek. I don't really call it a creek. I just call it a trend line liquidity. And that basically gives the market a reason for the market to come back down and take out all those stops that rest over here. And then long term, it's going to have to come back up to take out the money of the sellers, right? So the market tanks down to stop out all these buyers of this trend line, and then it takes that money out. And not only that, but if we also look at the second STNB, we can kind of see that there's more liquidity generated. Right over here, we have like this little, if we look at this from here, we have this area where the market comes back, rejects, and we have a bullish candle. A lot of people buy this expecting price to go up. Now, instead of that, price actually wicks down like this. And now this is the most important part. At this point, you want to be using all of your time frames. There's not a specific time frame, but you have to be using all of your time frames in order to actually properly understand this. So let's go down to the 4-hour time frame to understand our spring, and let's look at this. So the market goes down after taking out all that money, and it gives us the final spring. And let me explain why this was the spring. The reason this is the spring is because, one, it was such a quick move down that we know that it was because of liquidity. And right after that quick move down, we had such an impulsive quick move back up. Now, after the spring, if we go back to this, you're going to see a test of that spring. So basically, inside of your spring, what you want to be doing is looking for order blocks inside of your spring. So how do I know this is my spring? Well, at this point right here, when I seen the market show me this little downwards move, or sell side move right here, we have a high, we have a low, we have a lower high, and then we have a lower low. All I want to see is this little schematic of the lower lows, lower highs get broken. So let's see if that's what the price did. Let's see that if that's what the price did. Right here, we have that break of structure, right? Even though it was really small, but if we go down to the smaller time frame, you can see that this candle did close above. So we do have that break of structure of the highs. Let me delete this now. And then price wicks back down to do what? To test our spring to the pip. Now, if you didn't want to take this, you could have easily waited for a proper break of structure like this one right here. Either way, price action came back, and what did it do? It reacted perfectly off of our order blocking. In this case, our order block was this one right here. And this was the test of the spring. So spring plus test. The market basically came back to test that original area of the spring. So someone might say, okay, if I'm looking at the price right over here, am I going to know this is the spring? No, you will not know. The only way you'll know is after price action makes its move up. In this case, when I saw this move up and I saw that we broke the highs, we're making new highs, and I saw the momentum was here and the liquidity got grabbed, obviously this gave me enough confirmation to know that this is a spring. Now, generally what you want to do is set a limit at the spring of the test. So let's say this is my spring, which it is. You would want to set a limit. Now in this case, your stop loss would have been huge. You would have made it like 47 pips. Because it was that big, I did not take this trade, right? And you still would have got a decent 5-to-1, and you can see it perfectly taps you in and then goes your way. But because it did not, give me a proper risk to reward, I didn't take it. Now there is another way to enter accumulation schematics, and that's by the LPS. So my bad, so I was just taking the time. So LPS is basically in phase D, and this is basically that last point of support. So last point of support is the low point of reaction or pullback after an SOS. SOS is basically a sign of strength, breaking past the previous highs, identifying that the market is overall bullish. So right here, if we go down to the line chart, right, and I delete everything. Sorry, I don't want to delete everything, but let's go down to the line chart. Sorry about that, my bad. Yeah, so we're at the line chart right here, and what we see is that the market break above one high over here. My bad. It broke above one high over here and another high over here. We've seen that this move that I highlighted broke past both of those moves. Now, from a Waicoff perspective, this basically tells us that the market is overall bullish now. And exactly like what I taught you guys before in market structure, if we're breaking past previous highs, what does that indicate? That indicates that the market is overall bullish now. We have a low, or we have a high, we have a low, lower high, lower low, higher high, right? We broke past that and we made a higher high. So that does identify that the market is overall bullish now. And this is basically your sign of strength, which tells you that there's a significant buying pressure in the market and that price action is getting ready to go up / bullish. Now, LPS. It says that this is the last point of support where the market makes that last pullback and then goes up. Now, what this Wyckoff does not tell you is that the market makes a push back down into the LPS. In this case, right here, we can see that the market pushed up, created that last pullback, and then pushed up again. What we want to look for is that last area of supply. So in this case, sorry, not supplies, demand. We want to be focusing on that last area of demand before the major impulsive move up. In this case, like I said before, this is my major impulsive move up, right? Because this is what broke out. This is what broke all the previous highs. This is basically breaking out of the schematic. We were in a range from this major blue box. The market broke out of it with a ton of momentum. And basically that tells me that because this is the original breakout and all the momentum started over here and finished over here, that most likely this is a interesting area in price and banks and institutions are interested in getting into this point. So at this point, I would label this as my last point of support. Because why? This is that last pullback that the market made before an immense, huge push towards the upside. And this is my last point of supply. And now someone might say, okay, how do you actually enter this? It's so simple. You set your limit now. You set your limit at your LPS and just watch what price does. Right now, when I'm looking at price, I'm seeing price action is creating a ton of liquidity. We created liquidity of the lows over here that the market is leaving for long term to take out. Because like I said in my other videos, if there is liquidity above and below your areas of interest, it's really simple. That area of interest becomes really strong. Now, for the people that are still confused of Wyckoff, let me break this all down. And it's such a simple way of understanding structure. Right over here, we created this little prolonged down move, right? We have a low, lower high, lower low. Now once we have that low, lower high, lower low, we have that major impulsive move up, breaking a ton of structure towards the left, which does identify that the market is now overall bullish. Now what did I teach you guys from the beginning? Focus on that move that started the breakout and create and gave us that breaks of structure. In this case, this is that biggest momentum move, correct? And then this is our biggest momentum move. Now price already came back to tested this order block right here and give you your intraday move up, but what it didn't do is it did not come back down to test this level right here. So what we would do is we would simply focus on price coming back down into that level. And what's our confirmation for this? Well, one, it gave us a break of structure. What's our second confirmation? Two, we have a ton of liquidity that the market has to come to take out. And three, we have Wyckoff. If we want to use it, we can consider this as our LPS if we want to use Wyckoff, and this as our accumulation schematic. My bad, let me just quickly move this. And this as our accumulation schematic. So basically, I hope that was a good understanding of accumulation schematic. I'll show you guys a perfect example of a distribution now before we get to finishing this video. So USD CAD distribution. Let's see what we have here. So let me go down to the 4 hour first, and let's understand what the market just did here. So like I said in all my previous videos and all my lessons, we want to be focusing on that major expansion down, right? We want to be focusing on that major expansion down that gives us that breakout. In this case, we have multiple points of interest. One being this one, but this one already got tested with this one. So this one did not get tested. So at this point, we would focus all of our interest inside of this area right over here. Now, I went down to the smaller time frame, and this is something risky I did do for a intraday scalping trade, and you guys will watch the scalping video real soon to understand. But basically, I went down to the intraday time frame, such as the 15-minute, and what I saw is that the market, after it broke out, it created this last area of order block before the market pushed down. So we basically created this supply zone. Right now, as price came into my area of interest, let's go to the 3-minute time frame, I don't see any Wyckoff happening here. Remember, a distribution scheme, I'll get into all this, don't worry. But the idea of Wyckoff is just structure slowing down and reversing. That's literally it. Notice how price goes up. Let me do it real quickly. Let me just delete all this. Delete. Notice how in Wyckoff, price action is generally going your way, and then it's slowly reversing. It's basically really slowly reversing, and it's all just structure. Right over here, we can see that we have our PSY, which is the opposite of the preliminary support. It's preliminary supply. This is where large interest begins to unload shares in quantity after a pronounced up move. Volume expands and price spread widens, signaling that a change in trend may be approaching. So basically, the last area where people buy, this is when buying is finishing. This is that last impulsive move up, and then we have their buyer climax, which identifies that the market is going to give us our first move selling down. Now BC, SC, same thing, just reverse it. Automatic rally, we have with intense buying substantially diminished after BC and heavy supply continuing, and automatic rally takes place. The low of the sell-off helps define the lower boundaries of the distribution trend. So this is basically the market pushes back down to the original area of the PSY, and then we make an automatic rally back to the original area of the BC. Now after the BC, we have our secondary test, which is just testing any little bit of supply in the BC, and then the market pushes down and gives us a sign of weakness. Now after that sign of weakness, you're followed by a UT, and the sign of weakness is basically the market breaking a previous significant low, which identifies that the market is overall bullish now. Sorry about that. So from here what we can expect is that price action is overall bearish now. That sign of weakness is basically telling us that price action does want to achieve smaller targets, and it basically just wants to go lower. So after the sign of weakness, we have an upper thrust. So this is the exact same thing as a ST and B, rather in a distribution it's called an upper thrust. This is basically the market clearing any liquidity of the ST and the BC. So let me see if so I don't know why they don't have the UT here for some reason. It's really weird, but yeah, just take my word for it. That's what it is. Now the UTAD. So a UTAD is an upper thrust after distribution. this is the distributional counterpart to the spring and the terminal shakeout in the accumulation trend, meaning the opposite. It occurs in the later stages of the trend and provides definitive test of a new demand after a breakout of above trend resistance. So springs and shakeouts at upper throws after distribution is not a required structural element. The trend in distribution schematic 1 contains a UTAD, while the trend in distribution schematic 2 does not. So basically there's two different distribution schematics. All are the same, but one has a UTAD, one doesn't. So in this case, you have the UTAD, an upper throws after distribution, breaking above the UT, the BC, and the ST. So we have a 1, 2, 3, and then the fourth move up is that last move up. So we have 4 pushes above, 4 manipulations of the highs, and then we have that major mark down. Now we have the LPSY, which is our last point of support, last point of supply, not support. Basically this is where after testing support on a sign of weakness, a feeble rally on narrow spreads shows that the market is having considerable difficulty advancing. This inability to rally may be due to weak demand, substantial supply, or both. LPSYs represent exhaustion of demand and the last waves of larger operators distribution before markdown begins its earnest. So that's a little confusing, but imagine this LPSY is the same as this, but just different, like the opposite. So we have our last point of supply where the market does make its push down. We have that major push down, right? Once we do have that major push down, our last point of supply is basically the market creating that last pullback before actually selling off greatly. So let me go down to my USD CAD point and let's see this. So right over here, someone might say, how do you know which one is which? Let's go down to the line chart. Let's break this down. Right here, all right, we see that the market makes a push up, right? Let me break this down. We see that the market makes a push up. How do we know that this is going to be my PSY? Well, I don't know until I wait for price action to play the next few candles. So right here, once I see that major sell down, that's when I can assume that, okay, this is my PSY, this is my selling climax, right? Or is my buyer's climax, sorry. So right here, because this is that last point where the market made its full rally, after that we have our PSY, and that led to us having our buyer's climax, right? Now once we have that buyer's climax, what are we expecting next? An automatic rally. Now the automatic rally in this case, it was below the PSY. It doesn't always have to be above or below, but sometimes it comes in both pairs, which is completely fine. So we have an automatic rally below the PSY. Now how do I know this is my automatic rally right now? Well, I don't. The only time I'll know is when I see this few candles play out. So now I know that that's my automatic rally. So from that automatic rally, we have immense buying pressure come in, and then we have our secondary test where the market retests any little bit of supply inside of this area of the buyer's climax. So I can technically say, all right, this is my ST, my secondary test. Let me just break this now. Delete that, delete that, delete that, and then boom. So we have my secondary test. Now after the secondary test, what are we expecting? We're expecting a UT. So in this case, we have our UT, right? How do I know this is my UT? Well, let's look at it. Like I said, 4 drives. We have one drive, sorry, so we have 1, 2, 3. Now if you take the BC, it'll be 4. Let's take the BC. So 1, 2, 3, 4. We have 1, 2, and then this is the third one. So the market, the UT broke above the BC and the ST, right? Like it did over here, we have the BC and then we have the ST, and then the market broke above it with the UT. So the UT has to close above the secondary test and the buyer's climax. If it does not do that, it's not a UT. So in this case, we broke above the secondary test and the buyer's climax. At this point, all that's left is either the market's gonna come back and break above the UT, and then from there we'll sell off, or what the market is going to do is it's just going to sell off now, create our last points of supply, and then the market's going to come back into it. So until we do have that, we don't know much, right? So we need to basically just wait. Yeah, so let's play this out now. Let's see what the market does. And boom, right here, the wick of the previous high was broken above right over here. So we can say that, all right, this is our UTAD. Now how do we actually get in this trade though? One, you never ever just want to enter off of a UTAD. I know a lot of people do it, but in my in my, in my interest, I don't think that's the way you want to do it. What you want to do is wait for either the UTAD test, or you want to wait for price action to break the lows. So right over here we have the high, and then we have the markdown low, and then we have another high, right? What we want to see is price action break down like this. We want to see the market break down. Once we do break down, we're going to be expecting price to come back into like a last point of supply. So let's play this out. Let's see what the market does. All right, boom. Right here, we have that breakout. We have that break of structure of the low. Once we have that break of structure of the low, what do we do now? Someone might say, okay, what's our last point of supply? It's so simple. The market pushed down, created this last retracement, and then pushed down again. So clearly this is our last point of supply. So let me highlight this as my LPS. And at this point, all we would do is wait for price action to make its way back into my area of interest, which would be this last institutional candle, or this last institutional candle right over here, and then we could take a sell. Now remember, why am I taking this institutional candle as the LPS? One, because this is that last point of supply, right? This is that last retracement, and then after that retracement we had that breakout. So this retracement caused the breakout, and it's also a LPS. So all we do now is wait for price action to come back into our area of interest, and then from here we could take our sell. Let's see what the market did. So well, we already saw what the market did, but yeah. So at this point, what did it do? Well, it comes back into our LPS perfectly taps us into the LPS, and then from here we have a 3.8 stop loss, and TP would just be the next 1 minute low. So that could be over here. Because you're scalping, obviously you're on the 1 minute time frame, so you wouldn't be able to actually oh my laptop's about it. I have to wrap this up really quickly. Yeah, but you basically wouldn't be able to you know, go for crazy targets because you are on the 1 minute time frame. So you have to think about this from a strategic way. So basically price action comes, does its thing, and then eventually the market completely tanks and breaks down our next low, smashes our TP, and then from here it just did its thing, right? And I want to show you guys one more thing before I do call this video a day. So like I said, we do have the LPSY, right? We have the LPS right over here. Now, if we're looking at Waicoff from a different perspective, from the higher time frame perspective, for example, right over here, we do have distribution happening here. The market does push up, and then it does give us a schematic. Let's look at it. So let's look for the PS and the BC. Let's go down to the 1 hour time frame, and let's look at this. So where's the PS? I can technically say that this is my PS because this is that last move up before we had a major sell-off. So this is my PSY. And then we have our BC. So this is where the market created that buyer's climax where a ton of selling contracts started. So really what you're doing is you're just looking for the odd one out. You're basically waiting for patterns to break. This is the current pattern. This is what happened. And all we're doing is we're labeling what happened. So this is the buyer's climax. Now after the buyer's climax, we're supposed to be seeing an automatic rally. This is the AR. Technically this is the AR and this is the ST. Let's look at this from a candle perspective. It's not the cleanest, but as long as the line chart correlates with what the Wyckoff schematic is telling you, it makes sense. Now after that ST, we have that sign of weakness, right? SOW. Identifying that we're breaking past previous lows, and now that the market is overall bearish. Now we're supposed to see a UT, correct? We're supposed to be a UT. But in this case, we don't see that UT. You might say, okay, this is my upper thrust after distribution. But in this case, it isn't because it didn't break above the buyer's climax. But the reason, so this is considered as improper Wyckoff. It's still Wyckoff, but it's improper. But look at this. Even though that this is improper Wyckoff and we look at the candles, we still want to look at the overall breakout. The idea doesn't change. We're still in a distribution range. It's not a proper distribution range, but we're still in a distribution range. Now the market broke out of that institutional range right over here. Like I showed you guys, it breaks out of that institutional range. What we want to do is we still want to look for that beginning of that push down. In this case, what's the start of this major push down? Well, let's go down to the 4 hour time frame and look. Clearly we have two areas of interest, one being this last up candle before the move down, and then the second one being this last up candle before the move down. As these are both really close to each other, this one already got tested, this one didn't. Now technically speaking, you can consider this as your last point of supply. even though you don't have your UT or your UTAD, your last point of supply or last point of support, depending on which trend, or sorry, which what schematic you're in, it doesn't matter. As long as the support, sorry, as long as we have that breakout of the range and we do have that sign of weakness, all you want to do now is focus on that original area where the market broke out, and then from there find your last point of supply. How do I know this is my LPS? Well, it's simple. This is the last point before the market pulled back and then sold off. I'm focusing on the major breakout. This is that major breakout, so this is my LPS. And from this point, you can see perfectly, it literally missed your area of interest just by about 1 pip. Not even a pip, 3 pips. Missed your area of interest by 3 pips. That's how accurate it is. Now, if you wanted to use a different time frame, such as the 12-hour time frame, you could have been extremely successful with this just by highlighting this last institutional candle, right? And this is where I say use every single time frame. I use the 8-hour time frame, I use the 1-hour time frame, I use all different time frames. It all depends on different charts and what the current market cycle is. So for the people asking what time frame do I see Waicof on, I basically use all the time frames. There's not a specific time frame for it. It's just about trend, and it's just about market cycle and where the market is. Right now over here, I wasn't expecting this Waicof to happen until over here. Once I saw the market was over here, then I knew that this is all distribution Waicof. And then I knew that, okay, this is my LPS. The next time the market comes over here, I'll sell. And that's what happened. It does take a lot of time, but that's generally what Waicof is. Now we do have another traditional type of Waicof, which is more for confirmation. So let me go to Euro USD right over here. I'm sure I showed you guys this schematic before. Well, we have this, I think it was a 2 daily time frame. Yeah, we have this secondary daily institutional candle that we're focusing on. Now if we go down to the 5-minute time frame, just over here. Oh, I hate when it does that. So if we go down to the 5-minute time frame just over here, and we try to look for Waicof inside of a zone. Well, let's look at it. Let's go down to the Waicof and let's go to an accumulation schematic this time, right? Because we're looking for buys, so we basically map out our point of interest, which was the second daily institutional candle, and then from there, as price makes its way down into my zone, I'm basically going to be looking for Waicof confirmation. So let's look for my PSY, or sorry, my PS. Right here, if I go down to the line chart, what I can say is that basically this is my PS right here, because this is that last move down, right? So I'll say, all right, this is my PS. Now, after the PS, it might follow by selling climax. I definitely am right over here. We have that selling climax. Now, after that selling climax, we have an automatic rally. Yes, we do. And we have an automatic, or we have a secondary test after that automatic rally right here. Now, do we have a secondary test in phase B? Yes, we do. We have that STB. Clearing the lows of the SC and the ST. But look at this. Let's go down to the 5-minute time frame to get a better idea. But look at this. Now that we did mark up all this, right? We see this major impulsive move up. And we see that the price broke structure over here and it broke structure over here. It broke a ton of structure. At this point, if structure is telling you that the market is going up, this means that this is an improper accumulation schematic and that the market is not going to present you a you know, like the spring, the LPS, and what you're expecting. Instead, what I want you guys to do is focus on that momentum, because that's what we're trading. We're not looking to copy exactly this. We're looking to understand some of this so we can implement it on the charts. Right here, I see that the market breaks out. At this point, when we see that breakout, we're obviously going to be focusing on this last point of interest, which would be this 5-minute OB, because this is that last OB that was responsible for that major break of structure. And there's a ton of momentum here as well. So at this point, we would obviously look for the market to come back into our level, and then we take buys. Now, we also have liquidity forming right over here. The market is going to have to take out that money. And from here, blah, 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 the market does its thing. Damn, I hate when it takes this long. Alright, 30-minute. But boom, look at that. It taps you in perfectly to the wick, to the pip, sorry. And then from here, it does its thing and rallies up towards all the way the next highs. So that's generally how I use Waicof. Another way of using it is by mapping out your point of interest. For example, right over here, if you were looking to sell right over here, you have your POI. At this point, all you would want to do is wait for price action to come into your zone of interest and then look for Wyckoff. Or what you'll see a lot of the time happen is before it comes into your POI, you'll see Wyckoff play out. So let's look at a distribution schematic over here. So we have, let's look for a PSY. So PSY, it's supposed to be the last point of support or the last point of supply before the buyer's climax. So let's see if we can find that. Right over here, boom. Right here, I see it. So we have our PSY right here, our last point of supply. And right after that, we're followed by a major drop. Major drop right here. Now after that major drop, we have the automatic rally, right? And then you can technically say that this is your secondary test. And the fact that the market broke above the previous high, making this your UT, and it did not give you a UTAD, so this would be a secondary Wyckoff accumulation distribution schematic. So we have the UT, and then from that UT, we have a UT test. So let's look at the chart. Let's go to candles, and what do we see? After that UT, we see that the market comes back and gives us a test of that upper thrust, and then from there, the market sells off. Now, someone might say, okay, wait, what about the LPSY? No problem. You can do that too. Right over here, we have the automatic rally, and the market breaks below it. The market breaks below it, giving us a proper break of structure. Now, what we're going to do is we're going to go back up to here. Right here. So we have that break of structure. Now, what are we going to do? We're going to focus on the creation, the start, the beginning of that break of structure, which was this move right over here. We're looking for the cause. This is the cause of that break of structure. And what do we have inside that cause? We have an order block. We have an institutional candle. We have all this confluence now. So technically speaking, you can say this is your last point of supply now. And LPS, I always say, an LPSY is the best way to enter Wyckoff trades. Literally, it's the best. So from here, market taps in, because we already seen this hindsight. So market does tap in. So I'm assuming you did get stopped out if you did put your stop loss right over here like me. If you did put it above, you're fine. But if you did not, you did get stopped out. And then just target the next low for 24 pips. Right? And boom, market tanks down for a 7-1. And then from there, it reverses. And I don't know what it does from here. But, well, I do know it does end up selling off. Right? Let's go down to the 1 hour time frame to play this out. And then from here it sells off. So basically you can use Wyckoff as a confirmation. All it really is the market is doing its thing to give you better opportunities for okay, damn, 42 minutes. So yeah, all the market is really doing is giving you better opportunities for a better entry and better risk management. So I hope this gave you a general idea of how Wyckoff is seen on the markets, how we see all this PS, AR, SC, ST. But yeah, if you guys have any questions, make sure you watch the video again. Take care, not stay care. And I'll see you guys in the next one. Peace.